Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 34.97%, and it's beating the S&P 500 since the portfolio started. And our dividend growth stock portfolio has an annual return of 21.45%. It too is beating the S&P 500. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,385.58 after 139 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now I've added a tan line to this chart that shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks and bonds did not do well at all. And as you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech portfolio later in this video. And for those that have been asking, I'm looking to put details of these of the dividend portfolios on my website as well as real-time notifications. But I'm first looking at new website platforms that are more mobile friendly. But I'll keep doing these weekly videos as a free option for those that are just getting started and can't afford a subscription like I was back when I was an enlisted military member making very little money. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting 2 3/4 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week or the list of our best performers or any other section of the video. In 2022, the year we started the portfolio, as I mentioned, the market didn't perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,385. Return has been 21.45% per year, and last year the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed, because the portfolios were started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is 34.97%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 20.83% over the same time period. I would expect that the dividend growth portfolio would have a higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. Now remember, the high yield portfolio has only existed for 13 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio's return. This slide shows the growth of the dividends we've received in our dividend growth stock portfolio. The graph shows the cumulative dividends we've received so far. Our dividends for the last quarter increased 51% over the previous quarter, and our dividends this month, August, increased 94% over the same month a year ago. The portfolio's dividends were also boosted by a special dividend this week paid by Carrot Packaging. The company paid its regular dividend this week plus a special bonus dividend that was 43% of its regular dividend. Quite nice. So why do we only invest in dividend-paying stocks in our 2 main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. The second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom dividend portfolios only invest in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Now, here are two examples of stocks growing their dividend payouts over the years. The first is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 8.13%, and that's just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified stock portfolio. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents per year. Seemingly not much to get excited about, but over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds. But you certainly won't find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and tax brackets are adjusted. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gain. and then find the standard deduction, which can be located in IRS publication 505. As you can see in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to invest only $12.50 per week at the start, which is essentially the same as $25 per paycheck? The main reason is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck, in other words, equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boosted contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For a classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total weekly investment of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund, ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's annual return is 21.45%. Now, if we had instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would only be 11.5% per year, a difference of 9.95% per year. Now, our high yield portfolio is also outperforming SCHD, but by an even larger margin of 12.1%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio, both the high yield and the dividend growth. Though I prefer the dividend growth portfolio because it has got a more diversification. I also prefer our actively managed classroom stock portfolio strategies rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. It's just an algorithm picking stocks. SCHD has at times had large positions of stocks I consider to be value traps, and that's not a good thing. So this slide shows our best performing stocks in our dividend growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, is still in first with a 203.8% total return. A return of 200% means it has tripled since we bought it less than 2 years ago. Now that earnings season is winding down, there is not a lot of change in our top 15 stocks this week. I believe the only change in rankings is ITT moved ahead of Applied Materials. Stocks in yellow have been sold. And remember that total return includes both the dividends the company has paid as well as an increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called dividend growth stocks. 90% or so of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing dividend stocks this week. The overall market didn't move much this week, with the S&P 500 only posting a small 0.3% gain. Mid-caps and small-cap stocks fell 0.1%. Despite small caps falling this week, our four best performing stocks this week are all smaller, under-the-radar dividend payers, led by Build-A-Bear's 16.2% gain. Hub Group rose 7.9%, and Clear Secure makes another appearance in this list with a 5.7% gain. Before we look at the 10 stocks we bought this week, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. On the left are the 10 dividend growth stocks we bought a year ago for our dividend growth portfolio. Stocks in yellow have been sold. American Express has been the best performer so far with a 63.3% total return in a year, and FMC has been the only clunker. The average return of the 10 dividend growth stocks we bought a year ago is 25.25%. On the right side of the slide are the 8 purchases we made for our high yield stock portfolio. It utilizes 2 different strategies, and the strategies often overlap, meaning we make 2 purchases, or meaning we could possibly make 2 purchases of the same stock, as we did in this case with Fidelity National. So basically we made 3 purchases of Fidelity National a year ago. 1 for the dividend growth stock portfolio and 2 different purchases of Fidelity National for the high yield portfolio. Since they are 3 different purchases on the same day, they potentially have slightly different purchase prices. The average return of the 8 high-yield stock purchases we bought a year ago is 31.91%, despite 4 of the purchases not being held the full year. The annualized return for all 8 purchases is 43.1%. Obviously, our purchases won't continue that high rate of return, but it's a great start so far. Here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others online, but you always need to do your own due diligence, which is a fancy way of saying do your own research. Now, we don't sell stocks often, but we did make some sales this week. So here are the sales we made based on each stock's initial purchase. We sold 2 stocks that happen to be in both our dividend growth portfolio and our high yield portfolio. For the dividend growth fund, we sold both American Electric Power and Edison International because of their 4-way rating, which is based on 1, valuation, 2, quality, 3, recent dividend growth history, and 4, potential for future dividend growth. They fill out of the top 50% of investable stocks. Both were purchased on the same day. A little over 6 months ago. They're both purchased on the same day and provided similar total returns of 31.4% and 31.6%. Those are annualized returns of about 63%. Both had only been purchased once for the portfolio. We also sold both stocks for our high yield portfolio, but they made up a bigger part of the portfolio due to multiple purchases. They were held during different time periods in the dividend growth fund and provided total returns of 25.7% and 28.4% from their initial purchases. Annualized returns are 24 and 54. Now let's talk about the dividend growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week. But remember, we only buy 10 per week. We purchased the first 10 stocks on the list that are not in the yellow highlight. The stock in the yellow, which happens to be MasterCard, has already grown to be 4% or more of the portfolio, so we did not invest more in MasterCard this week because we want to build a more diversified, less risky portfolio. Now, this week's list is pretty similar to last week's list, with one change being ASML making another appearance on the list this week, coming in at number 9. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposits with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we were purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we were purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting a stock that is fairly valued as opposed to undervalued. This table on the slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating and quality grade, and dividend yield. The most undervalued stocks last week appeared to be Lamb Weston, Constellation Brands, and Qualcomm. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields were, in order, Bristol Myers, PNC Financial, and Morgan Stanley. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for about 90 to 91% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks for this portfolio, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision-making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits, also called earnings. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Nike, Microsoft, and FactSet. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings this week are MasterCard and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Bristol Myers, Lamb Weston, PNC Financial, and Morgan Stanley. All of these earned an A or A+ grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Bristol Myers and MasterCard. Both earned an A- or better grade. The companies with the best combination of recent dividend increases and potential for future dividend increases are Bristol Myers, MasterCard, Visa, and Lamb Weston. Scratch that. Visa did not make our list this week. And here are our trade confirmations from last Monday for the dividend growth stock portfolio. The two sales we had are outlined in red. We took the proceeds from the two sales plus the weekly deposit plus any dividends that had recently been received, and we then reinvested that in the 10 stocks on our buy list for the week, as you can see on this slide. On this slide, we're looking at stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, Dividend-paying companies raise their dividends by 5 to 6% per year on average, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Intuit, maker of TurboTax and QuickBooks, announced this week that they will increase their dividend by 15.6%. Ingredion also announced a dividend increase this week, raising its dividend 2.6%. This week, Lam Research, our fourth best performing stock in the dividend growth portfolio, announced it will increase its dividend 15%, but the Wall Street Journal hasn't added it to their dividend increase list, which is what this slide is officially based on. So I'll add Lam Research's dividend boost when the Wall Street Journal adds it to their list. Lam Research will also be splitting its stock 10-for-1 in October. The last 17 dividend increases for the portfolio have an average of 9.5% increase. Now this slide shows stocks in our portfolios that have chosen to split their stocks, since we keep track of every individual purchase in Excel, and there's a lot of them. It's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once the stock split has occurred. And as I mentioned, Lam Research will be splitting their stock 10-for-1 on October 2nd. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Sunday. Our top 10 holdings list did not change this week, as Legion and MasterCard remained at the top with 4.3% and 4.2% of the total account. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky and more diversified portfolio because we're buying additional companies instead of repeats. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Now, if you're a new investor, you probably don't understand this. You won't understand it until you experience our first bear market. And it's not if we'll have another bear market, it's when. It's just a natural part of the investment cycle and the business cycle. And this volatility often causes investors to panic and sell at the worst time possible, like many people did in the Great Recession in March of 2009, which was the bottom. A lot of people panicked and sold at the bottom, and they lost out big time because of that decision. Now, our portfolio holdings are at 99. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. Now, the thing that was time consuming was creating the spreadsheet. That took me 2 long years to create before I presented it to my students. Now let's talk about our high yield dividend paying stock portfolio. I've had several older students who are closer to retirement take my accounting classes. They are more interested in stocks with higher dividend yields and they asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annualized total return of 34.97% so far. Since the portfolio has been in existence for 13 months, that return will likely fluctuate a lot more than the return of our dividend growth portfolio, which has existed for over 2 3/4 years. Currently, the high yield portfolio's dividend yield is 4.14%, which took a dip this week as the portfolio saw a nice gain. But the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio, which is why I prefer that portfolio, but I use both. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we originally invested to 4.9%. Now, 2 strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features higher yielders, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds, that being high yield and dividend growth. Strategy 2 so far is the better performer, likely because of the good performance of its utility stocks and investment banks. The average investment in Strategy 2 has provided a total return of 17.08% and has been held for an average of 172 days so far, which is an annualized return of 39.9% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annualized return that high since stocks historically average about 9 to 10% per year. On this slide, we're looking at the high-yield dividend-paying stocks we bought this week. As mentioned before, one thing that's different about the higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks for the high yield portfolio. And we have 2 different strategies within this portfolio. Strategy 1 in red emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close to retirement. Strategy 2 in green still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2. If that's the case, which there usually is overlap, instead of stock getting a 1/8 weighting, they get 2/8, which is 1/4, which is equivalent to 25% of that week's investment. Now, both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought this week while implementing Strategy 1 are Bristol-Myers, Chevron, PNC Financial, and Morgan Stanley. The 4 for Strategy 2 are Bristol-Myers, PNC Financial, Morgan Stanley, and UPS. This week's purchases have an average yield of 4.2%, with UPS coming in the highest with 5.1%. Here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower on average than the stocks in our dividend growth portfolio, which of course consists of stocks with usually lower yields but a greater potential for excellent future dividend growth. And on this slide, we're looking at our trade confirmations from last Monday for the high yield stock portfolio. The 2 sales are in red, and we took the proceeds from those 2 sales, plus the weekly deposit, plus any dividends that had recently been received and were sitting in our account as cash, and then reinvested that into the 8 stock in our buy list, as you can see here on this slide. Now, it's been a while. Well, actually, I updated it last week. So, because my students love technology stocks, we started 2 technology portfolios. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio, but are both in the communications sector, not the technology sector. So far, the portfolio has increased 22.79% in less than 9 months. In comparison, technology ETF with the ticker symbol XLK is up 14.9% over the same time period. Best performers in our portfolio so far are NVIDIA at 147.9%, Meta Platforms 51.9%, then Broadcom, SAP, Pure Storage, and Fortinet. And as mentioned before, many of our students are extremely interested in tech stocks and have requested that we rank them separate from the dividend-paying stocks each week, even if the tech company does not pay a dividend. Many students find the tech stocks to be more exciting than dividend-paying stocks, and of course a lot of them like crypto too. So we started a second technology portfolio back in late April, April 29th. We started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, like the other dividend portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. I hesitate to call this a portfolio since it's limited to only one sector, that being the technology sector, but so far it's been fun to follow. Since this portfolio has started, it's outperformed the two dividend portfolios over the same time period, but that's a short time period since this was started on April 29th of this year. So how is this portfolio different from the $1,000 technology portfolio on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 64 days in this technology portfolio, but has produced an average total return of 9.03%. Using Excel's rate function, that's a crazy 63.2% annualized return. Obviously, there's no way it can sustain that rate of return, otherwise we'll all be rich really quick. Our goal here is simply just to see if we can beat the return of technology ETF XLK, officially called the Spider Technology Select Sector Fund. If we had instead invested our weekly investment into XLK, which fell this week, instead of a 9.03% average return over 64 days, we would get a return of 1.7% with the same average holding period. No sales have been made in the portfolio yet. Note that all these stocks are higher quality, meaning they must have a quality rating of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc., but we use a valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. The top 4 technology stocks on our list this week are Microsoft, Taiwan, Shopify, and Lam Research. So in the comments, let me know if you have any questions, and also let me know if there's any other type of investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as X and LinkedIn, and my website, beatthestockmarket.com. Hope you're having a great Labor Day weekend, and I'll see you again next week with a list of stocks we'll have purchased on, in this case, Tuesday, since Monday is a holiday. See ya.